Hello, everybody. Welcome to this webinar brought to you by Bursa Malaysia and managed by LifeChamp. Today's session is going to be on structured warrants. So this is titled Navigating Market Turbulence with Warrants. I'm sure that all of you here who have come across some stock that ends with stock code like C1, C2, CA, or some even start with H. So you might be wondering, what are these things? What are these instruments? Are they the mother share or these are some other things? Okay, and if you are wondering what are these things, yes, they are structured warrants, and I'm sure that you've heard of the term structured warrants for some of you here. And even though we have learned structured warrants, but sometimes it can appear very complicated because there are many Greek symbols there, and so today we have invited a renowned issuer on in Malaysia to talk about structured warrants. Okay, so who else to ask for structured warrants? The best to ask for is from the issuer themselves. All right, so we are very honored to have one of the issuers here in Malaysia to come and join us on this webinar brought to you by Bursa Malaysia. So let me go to the most important slide, which is this disclaimer. So whatever we cover on this webinar is only for educational purpose. In no way that we give any buy or sell recommendation to any stock or any warrants that the speaker does any case study on. So in the event that you do any trading, you're 100% responsible for your own financial decisions. Okay, so allow me to introduce the speaker today. Okay, Miss Amy joined the banking industry back in 2013, where she started as a market risk executive, covering several treasury products and equity products. So after being in the bank for 3 years, so she moved to become a senior associate in an advisory arm involved in financial risk advisory for financial institutions. She returned to the banking industry in 2018 and is now a warrant specialist in RHB Investment Bank. So Amy has 2 years of experience training more than 1,500 retail investors in structured products. Wow. Across more than 20 seminars and talks. So in fact, I had the opportunity to speak alongside Amy, I think for the past 2 years in several events and webinars together. So very excited to invite you back on with us here today, Amy. Are you ready to rock the house?
Yes.
Yes, very excited to have RHB as an issuer to come and join us on this webinar. So without further ado, we are all can't wait to learn from you about warrants. So let me just make you a presenter.
Yeah, okay.
Okay, so if you have always wondering what are structured warrants and you want to learn more, okay, this is the session for you. Okay, so yes, we are seeing your slide right now. All right, cool. Yeah, good to go.
Okay, hi, good morning, everyone. Hopefully that everybody is safe at home during this CMCO period, and thankfully that everybody is actually, I think many of you are actually joining us tonight, actually almost a full house of 500 over attendees. And without further ado, I would like to, before I start talking about warrants, maybe we look at the advantages of actually trading warrant during a volatile market. So if you know that this year the market, especially in Malaysia, has been very, very volatile. Like you can see like some stocks going way up and then it drop again and then it keeps going up and down, up and down. So this is what we meant by the volatile market. So one of the advantages of trading warrant during this kind of market is that you actually can gain exposure to the mother share at a lower price. So instead of maybe trading mother share like Supermax at a high price, maybe to gain exposure but at a lower price, you may do it through warrants. Besides that, one of the advantages is also the liquidity providers. So basically the liquidity providers, meaning to say a market maker, are available during the market making hours. So when it comes to warrants, we have this thing called the market maker. So these market maker are actually the ones that actually provide the liquidity for this product to be traded here and there. For example, if you're talking about the shares itself, so shares, how does liquidity works for shares is that it's based on your demand and supply. So people putting up like the number of volumes there, and sometimes it might so when it comes to warrant itself, the issuer itself, it's what we call the market maker. So we provide fair prices up there, so that investors can actually trade this product, enter and exit their position easily. So besides that, one of the advantages is also that when it comes to warrants, you tend to see a higher percentage returns, but also note that it comes with a higher risk as well. So because this is a leverage product, so you have to take into account that these are also quite a risky product. On the other hand, we also warrants allows you to take a view on both a bullish or bearish on the mother share, and it's catered more towards shorter term investors rather than longer term investors. So usually less than a year, which I will explain it later about the difference between the structured warrants and company warrants. And until end of this year, there is no stamp duty for any trades in warrants. So that could be one of the advantages as well for trading this warrant, because you get that stamp duty waiver, but it's until end of year 2020. So I think you have about until end of this December to actually enjoy this benefit. And last but not least, also for warrants, recently you also can get exposure to foreign markets in Malaysia. So some issuers actually do issue some index warrants over the foreign markets, like the S&P 500, Hang Seng Index. And recently also there's one of the issuer, RHB, actually has issued a Hong Kong stock warrants right here in Malaysia, which we will explain later on these warrants, foreign markets. So talking about the advantages, now we go on to what exactly are warrants. So they're actually a derivative. So what we mean by derivative is it's derived from somewhere. So the prices are derived from somewhere, meaning to say that it tracks the performance of the mother share. So if you're talking about call warrants, if the mother share goes up, your call warrant actually goes up. So this is what we meant, that is tracking and is derived from somewhere. And it trades like shares listed on the exchange. So meaning to say that as long as you have a trading account, how you trade your shares is the same way as how you actually trade the warrants. So for you to buy and sell this is the same way as how you buy and sell the shares, just like on the exchange. And last but not least, there are a lot of terms when it comes to warrants. So it could be quite complicated for some people that might think that, well, all these things like exercise price, expiry date, exercise ratio. So all these terms are in the warrants, and all these terms actually make up to other warrant lingo such as sensitivity and effective gearing, where issuers actually based on these terms, they actually derive what are the sensitivity and effective gearing for these warrants. And all these are the popular terms and lingo that you actually see in this warrant market, which of course we will also cover in the coming during this whole session. So like I mentioned just now, there are actually two types of warrants actually in the market. So you actually have this thing called the structured warrant and company warrant. So a lot of people may be more familiar with company warrants as compared to structured warrants. But in this whole session, when we are talking about navigating the market turbulence with warrants, we're actually referring to actually structured warrants. So to give a comparison on what is company warrants and structured warrants, if you take a look at the screen, so structured warrants are typically issued by financial institution. So what I mean by this is that it's actually issued by a third party issuer, not the company itself. Let's take, for example, if you are looking at let's say, for example, Datasonic. So if you're looking at Datasonic's company warrant, you are actually, the warrant Datasonic is actually issued by Datasonic itself. But Datasonic structured warrant is actually issued by third-party issuer, typically investment banks, for example, RHB, Macquarie, Kenanga, and so on. So if you're talking about Datasonic structured warrant, it's actually issued by people like RHB. So what happened by this is that the maturity for structured warrants are typically 6 to 12 months, so shorter dated as compared to company warrants, which is usually more than a year, and it can go up to 10 years. And there is this thing called a market maker for structured warrants, where the issuer themselves will provide liquidity for this product, whereas for company warrant, there is no market maker for this. And prices for the structured warrant is usually priced based on the price matrix, where you can see all the fair prices, but company warrants, your prices are mainly like your shares driven by the demand and supply in the market. And the naming convention for both are very different. So this is the thing that you would know how to determine whether I am actually buying a company warrant or I'm actually buying a structured warrants. So if I buy a structured warrants, the name tends to be -CA or -H. So C for call warrants and H for put warrants, whereas the company warrant is usually the W. So take, for example, just now the same underlying, let's say I'm saying Datasonic. So if I'm looking at Datasonic call warrant, the naming convention will probably be DSonic-C18 or DSonic-H10. So if I see a H or a C, that is the structured warrant. But if I see Datasonic DSonic-WA, then that W is actually talking about the company warrant. So what's the difference between these two is also that at the expiry date, if let's say you hold onto these two warrants, the structured warrants and company warrants, what happened at the expiry date is there will be a settlement. So usually for company warrants, most of the time, your settlement is actually physical settlement, meaning to say that at the expiry date, I have the right to actually buy the underlying share, convert the warrant into the underlying share and buy the underlying share at a specific price where it's determined in my contract, which is your exercise price. Whereas for structured warrant, it's actually cash settled. So cash settled meaning that it will be converted, but it will be settled in cash. You cannot buy the share. So that's why what we meant by structured warrant is usually a trading instrument as a short term, because the difference will be given to you in cash instead of giving you the right to actually buy the share in the market at the expiry date. So just now I mentioned also there are two types of structured warrants. One is the call warrant and one is the put warrant. So the call warrant actually increases in value if the share actually, the call warrant actually increases in value if the share actually goes up, but actually it drops in value if the share goes down. So it's both warrants are actually following your mother share. Basically, if for call warrant, if your mother share goes up, right? So then your call warrant will also go up. It will follow. But if your mother share goes down, for call warrant, it actually goes down as well. Whereas for put warrant, it's the other way around. The put warrant will increase in value if your share actually goes down, but it will drop in value if the share actually goes up. So in other words, if you have a bullish view on this mother share, this particular stock, and you want to gain a leverage exposure, you may want to you may look at the call warrant, because that's where when your value goes up and your call warrant also goes up. But if you have a bearish view, then you may look at the put warrant. So your value will go up if your mother share actually goes down. So there's the two different convention. And as I mentioned just now, to determine which is a call warrant and which is a put warrant, you look at the H and the C. So if you see the C's, that is the call warrant. If you see the H, those are put warrant. So don't get confused. I know some people might get confused, like, oh, maybe the H is a continuation from the C because C has finished already. But no, just to put it out there, the put warrant is actually the one with the H, and call warrant is the one with the C. So continuing from that, for example, let's say you are okay, you think that you want to try to trade or invest in structured warrants. So what actually happens if you actually hold it until expiry? Like I mentioned just now, structured warrants are cash settled. You cannot convert to actually buy the mother share, because that would be the company warrant. So for structured warrants, we look at this term, what we call, before we decide and know what is the end game for call warrants and put warrants, it's good to know that what are the difference between in the money, at the money, out of the money. So these are the three common terms that you might hear issuers actually mentioning, like, oh, this call warrant is trading in the money, or this call warrant is trading out of the money. So what exactly it means is that if you look at a call warrant, as long as your share price is above your exercise price, this is what we call an in the money call warrant. On the other end of the spectrum, the other end, when your share price is actually below your exercise price, then for this particular call warrant, we call it out of the money call warrant. So some people might ask, like, oh, how come it's out of the money, but how come my warrant still has value? So this is what we call the time value of the warrants. So there are two different value of a warrants. One is what we call the intrinsic value, and the other one is what we call the time value. So when your warrant is in the money, this is what we call the intrinsic value. So basically 3 ringgit 50 cent minus 3 ringgit, that's a 50 cents. So that's what we call intrinsic value. But then you might see, how come my warrant price is actually priced at 60 cents instead of 50 cents? So this is what we call the time value, because as long as your warrant has not expired, there's actually some value to it where we actually call the time value. So even if your warrants are out of the money, your warrants might still see a warrant price. There's a still value to your warrant price because of this particular time value, as long as your warrant hasn't expired yet. So moving on to that, we will see that once I talk about in the money, at the money, out of the money, then you come to think about it like, okay, now I'm holding a call warrant, right? So what happens if, do I sell it before the expiry date? Can I sell it before the expiry date? The answer is yes. So these are tradable every day as long as the market is open. You can actually buy and sell this product just like your shares. But just remember that if you've forgotten that you actually bought this warrant, if you've forgotten and you actually held it until expiry, what happens to my warrant? So on the screen, you can actually see this is how the end game works. What we call the end game is meaning until expiry date. So you're holding it until expiry date. So let's say today, in the example, this is just an example for information purposes only. Let's say, for example, Supermax. Supermax share price 9 ringgit 90 cents. Call warrant price is at 4 ringgit. So you go to the market, it's selling at 4 ringgit for the warrants. So you buy 1,000 unit of this 4 ringgit worth of Supermax shares. Then this Supermax share actually has an exercise price of 1 ringgit and 30 cents, 1.325, expiring next year with an exercise ratio of 2.1. So what happens at the expiry date is it will be cash settled. So basically, you will have the settlement price minus exercise price divided by exercise ratio. Settlement price depends on different issuers. Some issuer uses the 5-day VWAP, and some issuer uses the 5-day average closing price of the mother share. So what happens is that they will take the settlement price minus exercise price. So as I mentioned just now, call warrant, as long as your share price is above your exercise price, there is an intrinsic value, and this is what we call in the money warrants, in the money call warrants. So in the money call warrants, if it expires in the money, there will be cash settled. It will be around, for example, this example, it will be around 4 ringgit and 13 cents, assuming if, let's say, your Supermax price went up to 10 ringgit. On the other hand, the second scenario, let's say if your share price dropped all the way to 1 ringgit and 30 cents, which is below your exercise price of 1 ringgit and 325, 1.325, then there will be no payout. So there will be no cash payout. The maximum that you actually lose is the amount of money that you actually paid to buy this warrant initially, which is the 4 ringgit per warrant example. So this is an illustration, but let's say if we go to a real life scenario. So a real life scenario would be to give you a more better look at it. Let me show you one of the issuers website that you can actually do this for a real life scenario on computing and estimating whether your warrant would expire in the money if you plan to hold. So at the screen, you can see that I'm actually showing the slide, but let me go through this part. Okay, so in one of the warrants issuers website, under the warrant calculator, actually, let's say if you type Supermax C88, for example. So you scroll all the way down, you can actually see a simulated price for settlement calculator. So the valuations are all here. There'll be a 5 days. So you know that this issuer actually uses the 5-day average closing price, because in this website, it shows a 5-day average closing price. So in order to estimate here, so this would be the 5-day average closing price of your Supermax. So per warrant payout is actually here, which is 4 ringgit 3.56. So if let's say if you type in that you have 1,000 units here, so the total amount payout to you will be 4,356. So this is just a simulated, where it can be an example and simulated, but you have to check with the other issuers or any other issuers, including this issuer, if there is any additional charges if it's exercised. But this is just a simulation that you can actually look at it. So let me go back to the slide. So this is what we call, this is what I've covered on the call warrant. But recently, there has been more and more, basically, call warrant has been the more popular warrant that issuers actually issue in the market. It consists quite a large chunk of the total warrants in the market right now. But recently, there has been some issuer that actually have been issuing put warrants over mother share. So I will cover on actually put warrants. What would the scenario be? So let's take a look again at the moneyness of warrants, but this time from a put warrant perspective. So in the money, at the money, out of the money. So explaining just now, when it came to call warrant, when it was in the money, your share price is actually higher than your exercise price. That's what we call in the money. But when it comes to put warrant, it's the other way around. As long as your share price is below your exercise price, this is what we call the in the money put warrants. But on the other end of the spectrum, if it's out of the money, meaning to say your share price is higher than your exercise price, so that's what we call the out of the money put warrants. So similarly, this is what we call the intrinsic value and time value, same as your call warrant, just that remember put warrant is the other way around. So your view when you go into put warrants is that you think the mother share will go down. That's your view. You are bearish about this particular mother share. So that's why you decide to actually go into put warrants. So let's look at the end game, just like similar to the call warrant. What happens at the end game? Taking the same mother share, let's say Supermax share price 990, same as the call warrant just now, but tracking the same mother share. So both are tracking the same mother share, both are tracking Supermax share, both the share is at 990. Just that one's a put warrant and one is a call warrant. So let's say this put warrant is at 30 cents. So you pay today 30 cents per warrants, and the exercise price is actually 250 and expires next year, exercise ratio of 10. So on the expiry date, what happens? It will be cash settled as well. Just that instead of settlement price minus your exercise price, this one will actually be your exercise price minus your settlement price. So as long as your exercise price is higher than your settlement price, you will get cash settlement. So similarly, let's say if your share price went to 2 ringgit, right, below your exercise price of 250, so you get a total payout of about 5 cents. So but on the other hand, if you are actually, what happens if there's another scenario where your share price actually went up at the expiry date? It did not go down below your exercise price. It actually went above your exercise price, because your exercise price is 250, right? And your share price went up way above exercise price. So then you get no payout as well. So similarly, to give you a real life scenario, which is similar to this put warrant, where on the screen that you can actually see that this estimation of the put warrant, which is similar to the website. if let's say I key in Supramax -H, let's say I choose one of it, HB, for example, because remember H is put warrant and C is call warrant, right? So even if you click HB and you're not sure whether it's a put warrant or call warrant, you can actually see from this side that actually it says put warrant. Let me show you again. If I say C88, it will actually show that it's a call warrant. So going back to here, let's find HB. Scroll all the way down, has your exercise price and everything, and your assuming if this is issued by RHB, then you actually use the 5-day average closing price, right? Then you see your payout per warrant. So the payout per warrant is actually 0 because your prices, your mother share is actually way above the exercise price. So if you actually held this until expiry, assuming if today is the expiry, your payout will be actually 0, means there will be no payout. So again, the thing that you would lose if you actually held until expiry is the amount that you actually paid in the beginning to actually buy this warrant, which is actually 30 cents per warrant. So this is what the put warrant is compared to the call warrant. So now that we know that there are two types of warrants in this market, and I mentioned just now that how come when my warrant does not have an intrinsic value, how come there is still some sort of value in my warrants? And remember in the earlier slides, I was mentioning that it's due to this thing where we call time value. So as long as your warrants hasn't expired yet, you will still have some value for your warrants, where we call it the time value. So, but the time value tends to actually fall at a faster pace. Your time decay, that's what we call time decay. It will actually decay at a faster pace, closer to the expiry. So if you can look at this graph here that I'm actually showing right now. So this is what we call the time decay effect. Sometimes when I buy this warrant, let's take for example, if I buy a call warrant, right? So call warrant, if mother share goes up, my warrant price will go up. So let's say if I take this call warrant, let's say Supramax. Okay. Supramax mother share, let's say it did not move at all for the past 2 days, past 3 days, if it did not move at all. But how come my warrant value tends to drop even though my mother share stays stagnant? How come my warrant value tends to drop? Let's say it was 20 cents first, and then a few days later it was 18 cents, but then my mother share didn't move because we mentioned just now that it tracks the mother share. This is what we call the time value, because even if you're holding on to this warrant, even if there is no movement in your mother share, your warrant value may drop. So, and this is because of the time decay effect. And when it's closer and closer to the maturity date, the expiry date, it tends to drop faster. So it doesn't drop like a straight line, a linear drop. It actually drops like faster towards the maturity date. So that's why we always like to tell investors, or inform investors that warrants are generally a trading instrument. So you have to remember the important things, that the expiry date is very important. If you're already holding it and it's close to expiry, you may need to decide if, let's say, if it's going to be out of the money, then you would actually not get anything back, and you actually lose the amount that you initially actually bought this warrant. But then if your warrants, because your warrants are still tradable even before the expiry date, then maybe you may want to cut loss to actually sell the warrants quickly before it approaches the maturity date if it doesn't go your way. And also another thing to look out is also that warrants, even though it expires today, let's say, and the last trading day is actually 2 days before the expiry date. So your warrants actually get suspended 1 day before the expiry date. So you need to remember all these dates, and some issuers do actually send out some reminders to investors to let them know that the warrants are actually expiring already. Please be aware of the last trading date. Please be aware of when if you actually want to sell back the warrants, this is your last day that you can sell back. So this is very important when it comes to warrants, because of this time decay effect. So besides time decay effect, where a lot of issuers, you might see that when they mention like, oh, you might see slower time decay in this, you might see faster time decay in this. It's more for the people who are riskier, or this one is for people who may not may not want to take as much risk as the other risk takers. So you come across a lot of warrant lingos that you might be a bit overwhelmed sometimes. But what are the other few lingos that the important lingos that you need to think of? So one here, like I mentioned, is time decay. Another thing that I would like to mention is actually the sensitivity and effective gearing. So when you start going into warrants, you might always see this from issuers: sensitivity, effective gearing. But what exactly is sensitivity and effective gearing? So sensitivity in normal, simple terms, it actually means how fast your warrant moves. And effective gearing means how much your warrant actually move in terms of percentage. So these are the two different very commonly used lingo that you actually hear from issuers: sensitivity and effective gearing. So just remember, one is how fast, the other one is how much. So it's a FM, fast and much. So when it comes to these two, they tend to have a payoff between these two. So you may not need to, you may find that if you want a more sensitive, you might get a lower effective gearing. If you want a less sensitive, your effective gearing might be higher. So when it comes to sensitivity, it's all about responsiveness. How responsive is my warrant to the mother share? And when it comes to effective gearing, it's more of performance, meaning the percentage of your warrants. So more responsive, meaning to say a warrant with a lower sensitivity level, a lower sensitivity number, means it is a more responsive warrant. It means it moves faster as long as your mother share moves. On the other hand, usually, typically, all else remain constant, more responsive warrants tend to have a lower effective gearing, meaning to say that you might see a lower percentage increase in your warrant, but at the same time, at the downside, you would see also a lower percentage losses with a lower effective gearing. So let's take a look at sensitivity first. What does it actually tell me? So basically, sensitivity, like I mentioned just now, is how fast your warrant actually moves, how responsive. So let's say if I'm looking at front can as the mother share, I think front can might go up. I have a bullish view on front can, and I would like to gain a leverage exposure. Okay, let me take a look at what are the possible call warrants over front can that I may want to consider. So you take a look at two front can. You have two front can in front of you, and sometimes you might think like, how come I bought this front can and front can warrant, but when front can moves, my warrant price doesn't move? So it's because of the sensitivity level. So if you bought a more responsive and lower sensitivity level warrant, so sensitivity number, meaning that if you look at the table on your screen, it's actually showing a front can 2.1 ticks, meaning to say for every 2 steps of the mother share, when it moves 2 steps, my warrant price will already move 1 step. On the other hand, on the right side, when it's front can dash CQ, it has a sensitivity of 6.5 ticks, meaning if my mother share moves by 6 to 7 ticks, 6 to 7 steps, only my warrant move by 1 step. So sometimes when in a market, you might think that, oh, some issuer, how come this mother share moved already, but my warrant still hasn't moved? Is this issuer like, do they cheat my money, or is that what happens? This is boiled down because of the terms of the warrants. So you have to take a look at the terms of the warrants and take a look at the price matrix, where it actually can show you the different levels of your warrant price in correspondence to your mother share level. So that's basically what sensitivity means. So if your sensitivity number is lower, it means it's more responsive. If your sensitivity number is higher, means is less responsive. So think of it like the other way around. Lower means more responsive, move faster. Higher means less responsive, move slower. On the other hand, on the other spectrum, we have this thing called effective gearing. So what does a higher effective gearing tells me? So typically with a lower effective gearing, your warrant tends to have a higher price compared to a higher effective gearing, you tend to see a lower warrant price. So similarly, using the same example of Franken CN and Franken CQ, one was more sensitive, the other was less sensitive. But when it comes to effective gearing, like I mentioned, there is a payoff between sensitivity and effective gearing. So if you want a more responsive one, typically your effective gearing would be lower, meaning to say that your percentage change would be lower as compared to another similar warrant, core warrant, which has a less sensitive, but you tend to have a higher effective gearing, and it tends to be cheaper, lower warrant price. I would say lower warrant price, not cheaper, it will be lower warrant price. So the same example, assuming my mother share went up by 1.8%, Franken went up by 1.8%. There are two different kind of warrants. One went up by 4.8% and the other went up by 5.9%. So this is what we meant by one with a higher effective gearing, whereas the other has a lower effective gearing. But if it doesn't go your way, meaning to say if your mother share actually drops negative 1.8%, assuming it goes negative 1.8%, the core warrant Franken-CN and Franken-CQ. Franken-CN will drop by negative 4.8% and Franken-CQ will probably drop by negative 5.9%. So this is what we meant by effective gearing. So in simple terms, in another way of looking at it, effective gearing actually tells you, for example, if my share goes up by about 1%, how much percentage will my core warrant actually go up? At the same time, how much percentage it will actually drop if my mother share drops as well? So let's say 2.5 times effective gearing means for every 1% increase or every 1% change in my mother share, your warrant price could potentially change by 2.5%. So this is where you can actually see your effective gearing and sensitivity. Probably I can show you in real life. You can probably find your effective gearings. So you can probably find your effective gearing and sensitivity numbers here. And you can actually find in other issuers as well on their website. Okay, going on to from there, so when it comes to effective gearing and sensitivity, then you tend to think like, okay, choosing between both, right? Choosing between sensitivity and effective gearing. So which one do I actually choose, right? Do I go for more sensitive, more responsive, or do I go for higher effective gearing? So if you are someone with higher risk, you're a risk taker, so you may want to consider the one that has a higher effective gearing, which is typically less responsive. But if you have a higher risk, because when it actually goes your way, for example, core warrant, if you're using a core warrant, for example, if it goes your way, means your mother share goes up, your core warrant can actually see a greater percentage change compared to the one with a lower effective gearing. But always remember, if a higher effective gearing, meaning to say you are also willing to take a higher risk, because if it doesn't go your way, the core warrant will actually drop at a higher percentage compared to those with a lower effective gearing. But then what happens is that if you have a lower risk, like on the other spectrum, like I mentioned, that's why you tend to look at the lower effective gearing. So you typically look for the more responsive warrants. So the one that has a higher, lower sensitivity number, meaning a higher responsiveness. So that's what we think, that if you have higher risk, higher effective gearing, lower risk, maybe more responsive. But when it comes to real life, for example, if I'm already in the market and I need to think in what kind of situation do I go for the slightly higher effective gearing as compared to the other lower effective gearing. If I have two call warrants over the same mother share, let's just say in real life example. So in real life example, maybe if you are confident that there is going to be a sudden surge in the mother share, right? Then maybe you don't mind taking that risk. So you might consider the one which is have the higher effective gearing. But if you are someone who is looking at, let's say you're looking at the trend of the mother share, and you think that the share is actually trading sideways or range bound within a certain range, right? Then maybe you want to consider the one that is more responsive, because then you trade within that range so that it can go in and out easier, enter and exit easier, because as soon as it moves a bit, your mother share moves a bit, your warrant actually starts moving already. So that's in real life, maybe you might want to consider those that are actually at the range bound. So when I said that looking at your mother share, like I always stress on, you have to look at your mother share first, because a lot of people do ask whether you do technical charting on the warrants. The answer is no, you don't, because the warrants actually track the performance of the mother share. So you have to have a view on the mother share. You have to do your technical charting on the mother share to only determine whether you have a view that it will go up, range bound, or it will go down. Then only you decide to actually go into the warrants accordingly based on your view of the mother share. So that's something that that I would like to stress to people out there as well. So besides that, also in real life examples, you might also think that what are the strategies when it comes to warrants, right? So we have two types of strategies actually. So when it comes to warrants, there are two things. It's actually, we call it the investment strategy or the trading strategy. So if you have a longer investment time horizon, let's say 1 to 2 months. Okay, because warrants are usually typically less than a year, on average, maybe 8 months. So if you have a longer investment time horizon, maybe 3 months or more, right? So this is what we call the investment strategy of warrants. You may want to look at warrant that has a lower premium, because with a lower premium, generally you will see a slower time decay in the warrants. So when I mentioned earlier on about the time decay, where when it's closer to expiry, you actually see a faster time decay. Meaning if your warrants, your mother share don't move, your warrants price can actually drop as well. So what I mean by this, if the warrant has a lower premium, you might see a slower time decay as well. So you may want to consider and look at the warrants that have lower premium if your strategy is the investment kind of strategy. But on the other hand, if you are a trader and you are trading, meaning to say maybe you are thinking to actually trade these 3 days and then exit, or 1 day, 2 day, intraday, or 3 days as a short period, then you may typically consider a higher warrant price but a more responsive warrant. So the warrants that has lower sensitivity number, you might want to consider a more responsive, because you could see a faster change in the warrant. So as you trade intraday or 3 days, you just want to enter exit concurrently. So that's what we call the strategy when it comes to warrants. So besides that, also one of the tools that you can actually trade these warrants is actually using what we call the price matrix. So couple of slides back just now, I actually mentioned that it's very important to actually do your technical chart on the mother share, and you do not do a technical charting on the warrants itself. Because when you look at technical charting in the mother share, you are determining when is your view, when is it going to break resistance and all those things, and when you have to enter, when you have to exit, right? So that's your mother share. But when it comes to warrants, when you want to enter, when you exit, you can actually use this thing, what we call the price matrix. Because the price matrix basically shows you the different levels of your warrant price according to the different levels of your mother share. So if you have a target price of your mother share, and you have you can actually see what is the indicative prices that the issuer is actually placing out there in the market for you. So this is where you can actually decide when you want to enter and when you want to exit your position for your warrants after doing your analysis on your mother share, right? So how do I trade using this price matrix? On the left-hand side, where the price matrix is available in some of the issuers' website, where you can actually take a look at the issuer's website. And on the other hand, I have the market price, which is your trading platform. So on issuer's side, it's not a site where you can actually trade the warrants. You still need to have your own trading account to actually trade the warrants, just like your market. The price matrix is just for you to see what are the issuers' prices out there in the market. So let's take, for example, this Duo Pharma. This was actually 18 September last month. So Duo Pharma actually, let's say if the mother share bid is at 3.26 and the ask is 3.27, the call warrant Duo Pharma CG is actually 8.5 cents and 9 cents. So first step is determine your view on the mother share. Do you think it will go up? What is your target price for this Duo Pharma? Then take a look at the price matrix, which actually shows you the different level and the sensitivity. So if you can see, for example, this price matrix has a different shade of blue and white color, that actually determines when the warrant price will actually flip. So in this case, it will flip at when Duo Pharma's bids at 3.3 ringgit and 31 cents, it will flip to 9 cents. So this is how you actually read the price matrix. So the price matrix is also another tool where you can actually use to actually check whether there's any large spread between the warrant bid and ask price. Because when it comes to warrants, when it's a tight spread, meaning it's just a half a cent difference if your warrants is priced below 1 ringgit. But if you tend to see a large spread, for example, if let's say your bid is 8.5 cents and your ask is actually 12 cents, there's a large spread on your price matrix. This could be indicative from actually issuers that let you know that, okay, the ask price is actually maybe has been increased due to certain reasons, and issuer will probably inform you through their respective channels via their website or any their social media like Telegram and so on. So always take a look at price matrix that has actually a tight spread, and to ensure that whatever that's on the price matrix and your market is showing the same price, because that's your market maker price. Market maker means the issuer is placing there. So if you want to sell back, you can actually see that market maker is willing to actually buy back at what price, and actually market maker is willing to sell to you at what price. So think of it like going to let's say a money changer or so on. You see a buy price and a sell price. So it's similar to in that concept. Basically, what this price matrix is telling you that, okay, this issuer is actually selling to you at, let's say, 9 cents. But if let's say it goes up and you want to sell back to us, we actually buy back at 8.5 cents. And these are the prices that is fair and transparent to actually show you that what are actually the prices that issuer are actually pricing in the market out there. And last but not least, as I mentioned earlier on, it's also a tool where you can actually determine your entry and exit position accordingly. When should I enter and when should I exit? So maybe let's say you bought it when it was when Duo Pharma was 3 ringgit and 20 cents. And let's say suddenly you think that, okay, it might go down and I just want to exit my position. So maybe you can just exit before it falls to 3 ringgit and 21 cents, because then you will be break even and you might actually exit at the price where you bought at. So these are the useful things that actually I think some of the issuers actually have out there, which you might have seen, that is called the price matrix. So besides the price matrix, I've been talking about the local counters. There is, you can also use the price matrix for foreign counters. For example, recently one of the issuer, RHB, actually issued 4 Hong Kong listed stock warrants, Alibaba, Tencent, Meituan, and Me, in Malaysia. So these warrants are actually traded in ringgit Malaysia, listed on Bursa Malaysia, meaning to say you only need to have the same Malaysian trading account, and you can actually buy these warrants. It's just tracking the performance of the Hong Kong listed stocks. And actually those four, Alibaba, Meituan, Tencent, Xiaomi, actually consist of 82% of the Hong Kong Tech Index. So if you're not familiar, actually the Hong Kong Tech Index consists of 30 companies that are in the technology 30 Hong Kong listed companies that actually in the technology area. And these four counters that's actually issued in Malaysia, the four Hong Kong stock warrants that issued in Malaysia, actually made up of 82% in terms of market share as of 24th September, 82% of this HK Tech Index. So HK Tech Index is also in Hong Kong. You can actually track it. So using the price matrix for foreign counters, similarly, you can just key in and actually they will actually show you the same price matrix for the foreign counters. So to not confuse yourself, right, since this is listed in Hong Kong, right, so the exercise price is Hong Kong dollars because it's actually tracking the shares that's actually listed in Hong Kong. So when you look at the price matrix, the share, for example, Alibaba is actually Hong Kong dollar, but the Alibaba C1 is actually ringgit Malaysia. So 30 cents, 31 cents. Similarly to the Xiaomi. So if actually if I show you an example, let's say we just go back here and we key in Alibaba. Let me key in. Okay, it's actually like lagging right now. But basically, if you key in Alibaba, it will actually show the Alibaba price matrix there. Actually show the Alibaba price matrix there. You can actually see the different levels of the mother share and the warrant price. So the warrant price, again, as mentioned, is in RM, whereas the underlying is in HK, Hong Kong dollar. And these are some of the data that we actually extracted from Bloomberg itself, that actually the performance since 28 September, because these warrants were actually listed just on 28 September. So it has been a few weeks since it has been listed, close to a month already. Basically, if you can see, the Alibaba increased by 13%, and you can see the leverage that you actually have when it's the warrants. Alibaba C1 actually increased by 41% compared to the mother share, which increased by 13%. So these are all the performance of the Hong Kong stock warrants that is actually listed in Malaysia. And the last thing actually to note also is that it's different that Hong Kong actually stock warrants market making hours is different to Malaysia. So even though it's listed in the warrants is listed in Malaysia, but because it's tracking the performance of the Hong Kong stock, the market making hours is actually following the Hong Kong market. So these are the market making hours when it comes to Hong Kong. So basically, Hong Kong's open later and close earlier compared to Malaysia. So meaning to say, after these times when you see the prices in Bursa Malaysia, it's probably not the market makers prices. It could be investors prices out there. So these are the things that you need to be aware when you are actually interested in these Hong Kong stock warrants. So this is actually the last bit where one that I mentioned earlier on, the first thing that I mentioned in this webinar about the advantages to trade warrants during volatile market is this exposure to the foreign market. So if you think that Malaysia might be volatile and you might want more volatility, or you think that you want to look at other markets besides Malaysia, you might want to look at the Hong Kong stock warrants, where you need to just look at those Hong Kong listed stocks and take a view on the mother share there, and you can trade the warrants here in Malaysia with the same Malaysian trading account and your same brokerage fees, and also there is no stamp duty until end of year 2020. So with that, I think we can actually wrap up this webinar, and actually we can actually open up the floor to any questions, if there's any questions that we would like to take from the floor. So thank you. And I think I'll pass back to Shane.
Sure. Yes, thank you so much, Amy, for sharing with us how can we trade structured warrants in the Malaysia market.
We-
Okay,